Well, thank you for joining us today to learn how to keep more of what you earn as a locum tenens physician. I'm Rachel Jefferson with Weatherby Healthcare, a locum tenens agency that places physicians in positions across the country. And I'm very excited to introduce our presentation today with Alexis Galati, owner and lead tax strategist of Cerebral Tax Advisors, the founder of Cerebral Wealth Academy, and the author of the book Advanced Tax Planning for Medical Professionals. As both the daughter and spouse of physicians, she brings a personal perspective to this topic. I will let her take it from here.
Thank you so much, Rachel. I'm excited to be here. Thank you, everybody, for being here. And I'm excited to talk to you about what it means to keep more of what you earn as a locum tenens physician. As Rachel mentioned, I have lots of experience when it comes to medical professionals. That's what I specialize in, not only because I grew up in a physician household, but because I also am married to a physician. My husband and I have gone through the same sort of financial situations as most of Cerebral's clients, and know that, hey, you guys don't get that education during medical school or residency. And this really will allow you to get an idea of where to start and go from there. So again, yes, my name is Alexis, and I have 20 plus years in the tax and accounting industry. I'm an enrolled agent. I also am a certified tax strategist. I have my master's in business administration and my master's in science, my master's of science in taxation. And, we really focus on medical professionals, that white glove communication, and making sure that you are, again, keeping more of what you earn. So, what are the most common questions that I get as a tax professional, especially with someone new starting out in the locums tenens community? Well, most of the time it's, hey, what entity should I be? And, how much should I be putting aside for taxes? What can I deduct? How long should I keep my records for? And which retirement should I have? And also, too, once I've done all those things, what else can I be doing to lower my taxes? So these are the topics that we're going to go through today. I want to make sure that you know exactly, your options in terms of your entity, what you can be deducting, what your retirement should look like, and how you can be setting yourself up for success. So let's start with, what entity should I be? I mean, that's usually where you're going to start thinking about it. You're starting to make money, and there are several different options that you can take when it comes to your entity selection. And those are usually going to have to be set up very first thing as well. That one of the things that your whoever you're going to be paying with, with Weatherby paying you, will go and ask you, hey, where do you want this money to go? Do you want it to go into your personal bank account or into an entity? So what are your options? You can either be a sole proprietorship or single member LLC. You can be a partnership if you're going to have more than one person. You can be an S corporation, or you can be a C corporation. So let's discuss each of those options. Now, when you're starting out, you're able to just be paid personally in your social security number, as opposed to setting up an employer identification number, or EIN, and having your entity paid. When you're a sole proprietorship, 100% of your profit is subject to self-employment tax. And self-employment tax is Social Security and Medicare. And you're able to deduct all of your normal office expenses, business expenses, physician related expenses that are again related to that job that you're doing. Now, many of you might be thinking, well, hey, what about an LLC? And it's important to understand that an LLC, or a limited liability company, is a state formed entity that can actually be taxed several different ways. It can be taxed as a sole proprietorship, or partnership, or an S corporation, or a C corporation. So the LLC itself does not define how you're actually being taxed. it's the election that you make. It will tell you how you are being taxed, or the number of partners that you have will define how much you're being taxed. So sole proprietorship is just the default. If you're an LLC by yourself and you don't elect to be an S corporation or a C corporation, then you're just at default that sole proprietorship. 100% of your profit is subject to self-employment tax. Now, if you decide, hey, I'm going to do this with a colleague or maybe a spouse, and we're going to actually form a partnership, you have multiple members, then if you're just an LLC, then you're a multi-member LLC, and then you're automatically a partnership. And again, 100% of your profit is subject to that self-employment tax. Most physicians will think, okay, I've heard about S corporations. How can I be an S corporation? You have to go and decide if that is the right fit for you. Now, if you are an LLC and you do an S election by doing form 2553, then your income is going to be allocated differently between than if you were a sole proprietorship. So with the S corporation, instead of 100% of your profits being subject to self-employment tax, your earnings are allocated between W-2 wages and distributions or profit. And so the profit is not subject to self-employment tax. Only the W-2 portion is. And so that's where you get a bit of a tax savings. And it's really important to realize that you need to set up a reasonable compensation for yourself in order to keep yourself safe from IRS scrutiny. You can't just give yourself a really, really low salary. You have to actually pay yourself as if you are doing as if you had hired yourself off the street for that same job. So making sure that you are paying yourself an appropriate amount and that reasonable wage is giving you a proper base for doing retirement calculations, because just your W-2 compensation is part of the calculation for your retirement calculation. So if you are like, hey, I'm only going to pay myself $10,000 for the year, then you're not going to be able to give yourself a much bigger retirement contribution because it's limited to that $10,000 basically. So it's very much a dance or an art to deciding, hey, how much should I pay myself to keep myself safe from IRS scrutiny, as well as how much do I want to pay myself to put enough away into retirement as well. Now, it's important to note, just like with a partnership and an S corporation, even the C corporation, that there is a separate tax filing, where with a sole proprietorship, all that information for your business is reported on your personal tax return. An S corporation and a partnership are considered pass-through entities, which basically means that the income is being reported on the on the business tax return, almost like an informational return. And then that income is passed through to your personal return, where you actually go to pay tax on it. So you'll want to make sure to understand how your entity is being taxed and where that tax is actually happening. And also too, in some states for S corporations, the S corporation itself is subject to a state tax. That's very much the case in Tennessee, where I'm located. There is a 6.5% excise, franchise and excise tax. And so that is going to essentially wipe out any federal tax savings by having that S corporation. So it's really important to understand not only how your entity is being taxed on the federal level, but also the state level as well. So then that way you can make sure that the S corporation is truly the best fit. Like in Tennessee, for example, a lot of times staying that taxed as a sole proprietorship is actually a better choice because of that franchise and excise tax at the state level. Now, C corporations, they're considered completely different, or no, sorry, it's completely separate from your personal tax situation. They are taxed at the entity level. And right now that's at 21%. But it's important to realize that, yes, you'll be taking a salary through your C corporation, but any profit that occurs will be taxed at 21% tax rate, which sounds great, especially for a lot of physicians who might be above that 21% bracket. It's like, okay, great. It's going to be only taxed at 21%. But the thing is that in order to get that money out to take any distributions, or what it's called for C corporations, dividends, those dividends are then going to be taxed again at the 15 to 20% dividend tax on your personal tax return. So C corps are notorious for that double taxation. You'll want to make sure that if that's going to be the best fit for you, then you take into account, if you're trying to get any money out of your C corporation above and beyond your salary, that you go and take that that extra dividend tax into consideration. And a lot of times, most firms, especially with C corporations, will zero out their tax or their profit every year to their salary. So then that way they're not subject to 21% tax rate, but subject to their own tax rate, depending upon what they're looking at. A lot of times, so like in California is a state where you're forced as a physician to be a corporation to start with, a professional corporation, a PC. So California does not recognize PLLCs, or professional limited liability companies. So you have to start out as that C corp, unless you do an S election to become an S corp. And so most people in this, most physicians will do that S election to keep them compliant and have a better tax rate. So again, when it comes to entity selection, there are tons of different options. It really depends on where you live and how much you're making to decide what you need to move forward with. So let's discuss what you can be deducting as a business owner. Of course, you can be deducting all the normal business expenses. You need to go to Staples to buy office supplies, or you need to go and you buy equipment for your for your position as well. Then you'll need to go and just deduct all those normal expenses. You have to start kind of thinking like a business owner. What can I deduct that's personal, that can run through the business and be a legitimate business deduction? And some of the highlights, especially as a locum doc, you're going to be traveling quite a bit. You want to make sure to take advantage of automobile expenses. And so you can look at mileage, and which will allow you to you want to go and track all of your mileage, both personal and business, and then go and get a percentage. So like, let's say you drive 60% for business, then you can write off 60% of your vehicle expenses. So it's really important to make sure you're keeping track. And, if you are like, hey, I don't want to keep receipts, which you, by the way, for all of the things we're about to discuss in terms of business deductions, you really have to make sure to be keeping receipts. And we're going to talk a little bit more about that next slide. But you with the automobile expenses, you can decide whether to take actual expenses or to take the standard mileage deduction, which for 2024 is 67 cents. It goes down a little bit to 65.5 cents for 2025. And by the way, it's always important to kind of look during the year. The IRS will sometimes change that during the year, depending upon gas prices and other automobile expenses. So make sure you kind of keep up to date on that, but you can go and keep track of both of those. What I recommend is saying you have to keep track anyway of your business mileage, and you can compare between applying the business percentage to your automobile expenses and to the standard deduction and see which one is more. The same thing goes for, I'm going to skip down to office and the home. You want to be keeping track of all of your home expenses, like your home utilities, your monthly security monitoring system, you changing out your filters for your air conditioning, et cetera, all that maintenance, uh, homeowners insurance, property taxes, mortgage interest, all of those items can be tracked, and then you take a percentage of your home. So let's say you have a 10,000 square foot home, and 1,000 is going towards your office space, a very big office. Then 10% of your home office, sorry, of your home expenses can be applied to your home office, and can deduct that 10% of your or your home expenses. So um, it's really important to just keep track of all of those things, and to then so then that way you're getting the most of your deductions. You're again moving some personal expenses to being business deductions. Now, another great travel expense that a lot of locum tenens docs aren't aware of is the per diem standard rates. And this is great for tracking your expenses in terms of hotel and then meals and incidentals. So, incidentals are things like dry cleaning. Now, the per diem rates are set by the government. If you go to gsa.gov, or you even just Google per diem rates into Google, then it'll bring this up, and this will allow you to, depending upon where you're going, the IRS has set, or sorry, the government has set a standard rate, and depending upon what city you're in, of how much you can deduct without having to actually keep track of your expenses for your lodging and your meals and incidentals. So I know with a lot of locum docs, usually their lodging is covered, but meals might not be. And so if you go to New York City, and let's say that this for a day in New York City, they assume that you're going to be, the standard rate is $70 a day, but you're only go and pay $30 for that day for your meals, then you have an extra $40 of deductions that you can take without having to actually spend that money. So it's really advantageous for you to keep track of where you're going, and making sure that you compare your actual expenses versus the standard amount, standard per diem amount. So then that way you're getting the most out of your deductions. Another deduction that is very typical is your health insurance. I mean, for a lot of locum docs, you're not going to get your health insurance covered. You got to go out on the market and purchase that yourself. You want to make sure that you are going and keeping track of those, and not necessarily running it through your business, but you do have, if you're an S corporation, you do have to add those premiums that you're paying to your salary, and then you get a deduction for on your tax return. Another wonderful, and probably one of my favorite tax strategies, is the health savings account, the HSA. So if you have a health insurance account health insurance plan that is a high deductible plan, according to the IRS, then you're able to go and put money into your HSA, and that's triple tax advantage. So that money's going in tax-free, is growing tax-free, and then comes out tax-free when you use it for qualified medical expenses. And so there's myself and a lot of my clients will actually go and contribute the max every year, and then hold on to our receipts, pay our healthcare expenses out of pocket, and then we'll allow that to grow, because a lot of HSA accounts will allow you to grow the account quickly, like through investing it basically. And so that grows. And so in 30 years, when I actually want to go and get a hold of that money, I can go and submit my 30-year-old receipts in order to, get use of that money then. And then by that point, it's grown a lot more. Most likely you're going to have a lot of other health issues. And so you can use that at that time. A lot of other unreimbursed expenses that you might not be getting if you were doing W-2 were things like, if you need to buy equipment like loops, or even like subscriptions to certain periodicals or research, your cell phone, your licensing and board examinations, is, your CME. as well. If any of those expenses, all of those things can be deducted through your business. And so again, I really recommend you looking at, hey, what have I been paying for out of pocket? And that I've just always considered personal. And how can I have this be considered reasonable for being a business expense? Now, it is important to note, especially with the per diem, that for the meals and incidentals, that you make sure that you are not going to be staying in that one place for more than a year. And that's just because the IRS considers that temporary if it's under a year, and then it's considered more permanent if it's over a year. And then you won't be able to get your meals and incidental um, uh, tax strategy if you stay over a year, basically. Um, Now, when it comes to keeping records, I like to always stand on my soapbox for this. It's super important that you treat your business like a business. They have to have a separate bank account for your business, a credit card account, bank account, etc., because the IRS does not like to see the commingling of personal and business funds. So having that separated out is super important to legitimize your business in the eyes of the IRS. And you have to make sure to keep itemized receipts, and because the IRS does not count credit card statements or bank statements as being a receipt. They need to actually see what you purchased, because if you go to Costco and buy $5,000 of something, they don't know if that's a new computer or if it's food. They need to actually see it. So they can technically deny the deduction if you don't have the receipt. And it's important to keep those receipts for a minimum of 3 years. The IRS has 3 years to audit a tax return from the filing date. So I usually recommend that you keep it for 7 years, maybe even 5 years, but it's just because I'm also an accountant, and that's for our own records. We like to keep things for at least 7 years. Right now, since everything can be digital, especially when it comes to receipts, by all means, keep it digitally in a Google Drive or Dropbox, something like that. So then that way you have it if the IRS were to ask for it. And having an accountables plan set up is really important for any business. And this is kind of a quirky thing that the IRS requires, especially for S corporations and C corporations, because you need to basically give your business permission to reimburse you for business expenses paid with personal funds. So if, let's say, you do go to Costco and you buy a bunch of food and you buy a new computer, and you put that on your personal credit card, then you need to submit that receipt for that $2,000 computer to your business through your accountable plan, and make sure that it gets reported on your business return. And I highly recommend using technology to help you with that record keeping and keeping track of your personal expenses and mileage, et cetera. So I'm a big fan of QuickBooks Online. That's what we use at Cerebral. And but even just using something like Excel to help you keep track of those income and expenses is going to be really helpful come tax time, and for you to actually have a pulse on what's happening in your business financially. And I like, for personal use, I like Monarch Money, like, they don't have Mint anymore, but Monarch Money or Empower, et cetera. That really allows you to keep track of your personal expenses and investments, et cetera. When wanting to keep track of like all of your home expenses or your automobile expenses, it just allows you to, automate a lot of this process. And that way you are in good shape for tax time. It will save you a lot of headaches as well. Using MileIQ, or even if QuickBooks has a mileage tracking app through there to help automate the tracking systems. Just please use technology to your advantage. And there's lots of different options out there, but these are just a few that you see on screen. And so just in general, again, keeping track of everything is really important. When it comes to receipts, keep track. Again, you can use even it's just as simple as keeping a folder tree where you have 2024 or 2025 receipts, and then subfolders for each of the categories. Just put them in there, like, hey, I just did some travel, here's travel expenses, or I went to Staples for office supplies, put it right into there. For meals, again, you want to keep track of all of your business meals as well and write down in some intent of business intent of that meal on the receipt before you forget, take a picture of it, put it away. So again, I'll get off on my soapbox on when it comes to saving receipts, because 90% of a fight with the IRS is documentation. So it's really important. Well, let's get into something that's a little bit more complicated. Let's just talk about retirement. I mean, this really is a low hanging fruit when it comes to tax savings and wealth generation. And of course, most people think, hey, I'll just set up a SEP IRA. Well, that's great. SEP IRAs are okay, but actually, I hardly ever recommend them. And that's mainly because they doesn't allow you to do a tax-free backdoor Roth. And so we'll get to a backdoor Roth in a second, but there are just better options, especially the 401k, which will allow you to do a tax-free backdoor Roth. Although SEPs are inexpensive, you also have to remember too that they only allow for employer contributions, which means that's coming from the business, where the solo 401k allows for an employee deferral and an employer contribution. And so if your income isn't as high, if that W-2 isn't as high within your business, then the solo 401k can actually allow you to put more away than the SEP IRA by itself. Now, for 2025, we're looking at 70,000. That's up from 69,000 max for the SEP IRA and the 401k, and there's 69,000 for 2024. The solo 401k, as I mentioned, since it has both the employee deferral and the employer contribution, they allow for 23,500 employee deferral, and then approximately 25% of profits if you're an S corporation, up to again that $70,000 limit for 2025. Now, 401ks do have a bit more administration involved. They are less inexpensive, but you have to do a Form 5500. You have to report on a tax return to the IRS how much is in your retirement account, because they're nosy. So another great option though is a defined benefit plan or a defined pension plan that allows you to put even more away into retirement if you want to go above and beyond that 70,000. Now, the SEP IRA and the solo 401k are defined contribution plans. And so that means that the IRS is defining how much you can put in each year, which is that, again, that 23,500 or even that 70,000 max. Where with a defined contribution plan, that is with the defined benefit plan, that is the IRS defining how much you're allowed to put away into that plan. So they're defining the benefit. And right now it's about 3.5 million by the time that you retire. So let's say you're 40 years old and you do have a retirement age of 62. Well, then you have 22 years to reach that 3.5 million. So you can understand where you're allowed to put in a lot more into a defined benefit plan because you have that shorter period of time to reach that dollar amount. And of course, if you're older, let's say that you're 52, then you only have 12 years to get to that point. Now, and you can redefine that retirement age, of course. But these plans are a lot more expensive because you have to have an actuary involved. That's a third-party administrator to not only do the annual calculations and the IRS compliance with, doing that Form 5500, but also if you have employees, you have to make sure that you include those employees in any of these plans. But it can get a little bit more expensive. But in my experience, the cost benefit is very much on the side of having a retirement plan that you can be putting money away into. And so far we've talked about, these are all pre-tax contributions that I've been discussing, but for a solo 401k, you can have a Roth option. And that does allow you to, if you guys have heard about mega backdoor Roths, being able to do that as well. Now, but talking about the normal every day sort of backdoor Roth, this is really important, especially for locum docs, because you guys end up making up too much money to actually do a direct Roth contribution. And so this strategy allows you to put your $7,000 of your max, if that was for 2024 and even for 2025, um, into your Roth IRA by first putting it into a pre-tax IRA and then allowing you to roll that over to the Roth IRA. Now, that's going to be a tax-free conversion because you're putting in post-tax dollars. However, if you do have any traditional IRAs, SEP IRAs, or simple IRA accounts with balances at the end of the year, then you might be subject to pro rata rules, and that backdoor Roth conversion will be partially taxable. So that's really important to work with your tax advisor to make sure that you are set up to do a tax-free backdoor Roth, and that $7,000 isn't being taxed twice. Okay, well, let's talk about some additional strategies. And a lot of people talk to me about, hey, I have a spouse or I have children, and I'd really like to pay them money for working in my business. And this is a great strategy. The court tested age is 7 or older. Yes, you can hire them younger, but it's more difficult to substantiate their salary. And this is really allowing you to shift income from your higher bracket down to their non existent tax bracket. In 2024, you can pay them up to $14,600, and in 2025, up to $15,000 before they even have any taxable income, or sorry, any taxable liability. You just have to make sure that if you have a teenager, for example, that's working at Baskin Robbins, that you account the money that they're earning from there in that $15,000, for example, for 2025. And that follows the standard deduction, by the way. So you can, for an individual, so you can kind of look that up yourself. But this is a really great way for you to not only save for their retirement, but to also go and pay off some of their support. And this can even be done for a parent if you're supporting a parent and you have them work in the company. Now, a lot of people might want to hire their spouse, and this is great for if you want to put more away into retirement, have them put more in and put away for their retirement as well. That's really the main reason for doing that with the spouse. If they're not going to put money away into retirement, then you don't want to pay those extra payroll taxes. But also too, if you have a spouse that might want to travel with you to like CME or other business events, that's a way for you to write off their travel through the business as well. Medical reimbursement plans are wonderful too. If you have a family member that you has a lot of medical expenses and you're not eligible for an HSA, then this is a way for your business to reimburse you for all of those out-of-pocket medical expenses. And there's very specific ways that you have to set it up to make sure that it works out. Like if you're a sole proprietorship, then you have to make sure to have a spouse as an employee, or if you're a C corporation, then you can be the employee. But this is a really great way for you to write off medical expenses. If you generally say if it's $10,000 or more of out-of-pocket medical expenses. There's also lots of different strategies around tax advantage investments, things like oil and gas programs or rental properties. This will allow you to lower your taxable liability through these different types of investments, whether it's through depreciation with a rental property, or with oil and gas. There's an upfront deduction for the investment that you're putting in, and it helps you also diversify your portfolio. There are also several states that have incentives, tax incentives and credits for those that are primary care physicians, as well as if you're going and working in rural care. These are just a few states that I've listed that have these advantages. And so you want to take a look at where you're going to be working and seeing if the place that you're going to be working at will have those programs available. Now, great, you've earned all this money, you're saving all this money. What's the IRS's take, and what part do they want in this, and how can you make sure you're staying compliant? Well, when you're a W-2 employee, your taxes are being taken out on your behalf through your pay stub. But when you're 1099, no taxes are being withheld. And so the IRS, they want their money when you earn it. And so they say, hey, on a quarterly basis, you have to be making payments based on how much you're earning. And you either have to pay 110% of the prior year tax. That's if you are over $150,000 of taxable income is 110%, 100% lower. But basically, you'd have to either pay 110% of the prior year tax or 90% of the current year tax to stay safe from underpayment penalties. And that's whichever one is lower. So if you're not quite sure, well, how much tax am I going to have at the end of the year? The safe bet is to just do 110% of the prior year tax, especially if you know you're going to be earning more in the current year. Then that will at least keep you safe from underpayment penalties. And don't forget that this isn't only just for the IRS, it's also for the state. And the state conforms to the IRS. So it's the same, that 110% of current year or 90% of the prior year tax. And I highly recommend you make a those payments online through irs.gov or the State Department websites, as opposed to mailing a check. You wouldn't realize how many times we've seen people writing checks and it gets posted to the wrong account. And then it takes forever to find out, okay, where did the IRS post it to the wrong account or it gets lost in the mail. If you do mail it, you want to make sure to send it certified with a green return receipt. So you know that they got it and they can't say, oh, well, you never sent it. You need to have proof that you've sent these things. Where if you just do it online, you get immediate confirmation that it's been paid and you can save that for your records as well. Thank you so much for being on today. And I know that we went through things very quickly. There's so much that can be covered, but hopefully this gives you an idea of where you can start, what you can be deducting, what sort of retirement that you need to be on. And so then that way you can at least start thinking of these things and setting yourself up for success. If you have questions, please feel free to reach out to me. Check out our website. We have lots of free resources on there, as well as Cerebral Wealth Academy, which can help you guide you through this entire process. Thank you so much.
Well, a big thank you to Alexis for sharing her expertise and guiding us through some critical tax strategies. We hope you've gained some valuable insights into how you can keep more of what you earn as a locum tenens physician. If you have any tax questions, as Alexis mentioned, please reach out to her. And if you'd like to learn more about how Weatherby Healthcare can support you and your locum tenens career, please don't hesitate to reach out. We're here to help you make the most of all your opportunities. So thank you again for joining us, and we look forward to connecting with you soon. Thanks again.